Welcome to the look ahead for the coming week. Today is January the 10th. We'll be taking a look at what's going to be happening in the markets as from the week of the 13th of January. Second full week of the year before we know it. So just before we get going, I'm going to ask you to take a few moments to read through the risk warning. I'll pop myself on mute whilst you do so, and then we can crack on with what we'll be watching out for next week and potential trade setups to trade those events. Okay, excellent. So as always, let's just take a look at the economic calendar and what is showing up as what to be watching. Here we go. This is the economic calendar on the website, which I have filtered for next week, and also the high impacting data points. But just before we kick off with the economic calendar, quick look at what's been happening this past week. Main story, I think, is basically we've got a US dollar strength story. US dollar continues to trade, well, it has risen across the week, trading back up at its highs that it saw at the end of 2024. We've seen strong US data. We've seen reviving concerns over inflation. We've seen that's coming from the strong data, and as the jobless claims fell to 11-month low. We've also seen the ISM services PMI was stronger than expected. The prices paid component was also much stronger than expected. Again, reviving those inflationary concerns. We've had the Fed minutes, which have also been a bit more hawkish, suggesting that the Federal Reserve will be much more cautious in cutting rates this year. Obviously, we've got the US non-farm payroll. That data hasn't been released at the time of this recording. So it was a dollar positive story, but it was also a stocks negative story. So as we've got those expectations surrounding a more hawkish Federal Reserve, that's taken its toll on stocks, which are set to fall across the week as we speak, around 0.5%, marking the second straight weekly decline. Other thing that we've been listening to this week is obviously Trump, as he nears his inauguration on the 20th of January. There have been many discussions surrounding trade tariffs, whether they've been more, or will they be more aggressive, less aggressive? There have been reports on both sides. Will he be buying Greenland? Lots and lots been coming out from the Trump arena. So that will no doubt continue across the coming week. But we've also got earnings season, which kicks off this week. Now, earnings season will begin with the banking giants. We've got JP Morgan, Wells Fargo, and Citigroup, along with Goldman Sachs, all due next week. Now, according to data group FactSet, earning growth is expected to rise by 11.9% year over year for the S&P 500 companies, which would mark the highest year over year growth since Q4 2021. Now, if we break this down into sectors, the financial sector is expected to lead with projected growth of an impressive 38.9%. That's mainly thanks to the banking industry's favorable comparisons compared to the same quarter last year. Communications are expected to post growth of 20%, tech stocks 13% growth, whilst healthcare, consumer discretionary and utilities are also expected to post growth of around 10%. Now, revenue expectations for the S&P 500 is expected to maintain its revenue growth for a 17th straight quarter with a 4.6% increase. Tech firms are expected to beat revenue growth thanks to ongoing digital transformation. Now, that's going to bring attention squarely onto the S&P 500, which we are seeing here. After reaching that all-time high of 61,000 at the end of December, we saw that sharp drop lower, but actually now it's consolidating between this range here. So between around the 60,000, 15, 60,000, and on the lower side, we're seeing some support there around the 58.25 level, which is also the 100 SMA. So we've seen a failed attempt at the start of the week to get back above that 6,025 level. We're down below the 50 SMA again now, and just holding steady around this level of 5,900. As far as the RSI is concerned, momentum is slightly towards the downside. So, I mean, support on the downside is there at the 58.25 level, as I mentioned. Sellers are going to need to take that out in order to create a lower low and extend and form a bearish breakout towards the 5,700 level. If we're getting sort of strong, encouraging earnings, upbeat projections, then this will be the level to beat on the upside, the 60,025 to 60,050 zone. Sorry, 6,000 to 6,025 zone. That's going to then open the door back up to that 61,000. Now, it's not just the earnings season we've got going on in the US. We've also got US inflation data as well to be a key focus. Now, inflation in the US has proven to be sticky. Federal officials have been placing a great deal of emphasis on inflation progress in order to proceed with further rate cuts. And that was highlighted particularly by Christopher Waller, Fed governor, last week, along with other Fed speakers. Now, the markets, as a result, will be watching CPI closely. In fact, I think CPI is likely to be more of a market mover potentially than the non-farm payroll reports today, given the more emphasis on jobs, on inflation compared to jobs at the moment. Expectations, well, we saw US inflation rose to 2.7% year on year in November. That was up from 2.6% in October and marked the third straight increase in inflation. Now, more strong data. We had strong data last week, as I pointed out. The services ISM PMI prices paid subcomponent pointed to rising inflationary pressures. Now, if we do get stronger data, that could spark more strength in the US dollar and pull stocks lower. However, if we do get a softer inflation report, which isn't necessarily expected, but given the sharp rise in Treasury yields over the past few months, I think that's where we could see the bigger market reaction. And that situation would support stocks and lead to more gains in the stock market, but the US dollar may come under pressure. But if we just have a look here, US dollar, Japanese yen, being boosted by that rise in US Treasury yields, we've seen an extension of the recovery from that 149, 148.64 low, rising to this level here around the 158.50 level. Now, interesting, the run up has just sort of steadied off a little bit. It's not as strong as we've seen. We've seen a bit of consolidation, which is keeping the RSI out of overbought territory. But if we do get some hotter than expected inflation figures next week, then I think, that's going to bring the 160 level into focus, particularly if we get a solid jobs data report as well. What's going on in Japan is we saw an increase in household spending. We've seen wage growth rise as well, which is increasing optimism regarding the Bank of Japan rate hike, but that doesn't seem to be sufficient to carry the yen higher against those powering US Treasury yields. So we've got on the upside, the 160 level, and then obviously that opens the door then to the 162 high that we saw in 2024. On the downside, this level here around the 157.10, that's the 78.6% fib level from the 162 high to the 139 low. And if we get a break below there, then that's going to bring the focus to 155. the round number. But I mean, you know, it's going to take that would negate the very near term uptrend. But I mean, in order to get a lower low, we'd be looking for a move below the 149 level. So, you know, at the moment, this is bulls are very much in control of that trade. I guess whilst we're talking about US dollar and inflation, it's always a good idea to have a look at the gold. Now, we've seen gold's been on the rise. It's been steadily rising from that December low that we saw of 25.83 back above the 100 SMA, which is pretty important because it's been trading above there for quite some time. Also above the 50 SMA now, and it's probing resistance there at the 26.80 level. So that's due to the sort of safe haven flows that we've seen this week amid concerns over what the Trump administration may bring, which tariffs it might impose, and just general uncertainty around what's next as far as the US economy is concerned, given that Trump is about to take power. So yeah, I mean, that's the level that we're going to be watching for buyers. The thing is, if we get hot inflation, that actually could give the US dollar a boost and bring gold level lower. However, if that's combined with sort of ongoing rhetoric from Trump, particularly fighting sort of rhetoric against large trade tariffs, then that could help gold get above that price. On the downside, as far as key supports, I'll be watching out for the 100 SMA there at 26.33. I mean, we can just see that that's been a really, really strong support for gold, dynamic support for some time now. And below there, we've got the 2600 level to be watching out for. So let's just have a look what else we've got going on. I suppose we're going to stick with the US. We've also got US retail sales, which are due out on, there we go, there they are, on Thursday. So retail sales have continued to really highlight the ongoing resilience of the US consumer. Expectations are for US retail sales to rise 0.5% month on month in December. That's down slightly from 0.7% bear with me, in November. But still that's a solid number, showing that consumers are willing to spend. And according to recent MasterCard data, the Christmas season was also a merry one for US retailers, as sales increased 3.8% from November the 1st to the December 24th compared to the previous year. So again, that data sort of shows that the US consumer is willing and able to spend. Now, solid retail sales will likely add to the view that US economy remains in a firm position, and potentially giving the Federal Reserve fewer reasons to cut interest rates. Now, the market is only expecting one rate cut from the central bank this year. If we do get upbeat data, that may just fuel expectations further that the Fed is in no rush to move, which could have a negative effect on US stocks. Now, this is the NASDAQ. It's been trending lower after reaching that all-time high of 22,100. We see a series of lower lows here. We're finding support around the 50 SMA at the moment, which is at around 21,100. Now, if the price does break through below that level, this one here is pretty key at the 21,700, 800 zone. That's where we've got these two lows from earlier, one at the beginning of January, one at the end of December. We're going to break below that. That's going to create a lower low, and sellers could gain momentum. However, should we find those supports hold, then on the upside, buyers are going to want to look to take over 21,200, and then we've got the 21,500 on the way back up to 22,131 and fresh all time highs. What else we got going on? Let's focus on the UK. Oh, we've got PPI as well, actually, from the US. But again, I think the main focus is, well, it'll almost certainly be on CPI. So that's just something to keep in mind. We've also got UK inflation to be watching out for. Now, UK inflation, that rose 2.6% year on year in, bear with me, year on year in November, up from 2.3% in October. And again, highlighting this stickiness in inflation. Service sector remains well above the levels that the Bank of England is comfortable with, and wage growth remains strong at 5.2%. Now, the service sector inflation is intrinsically linked to wage growth. So if we keep wage growth sticky, then that's going to likely keep service sector inflation sticky. Now, sticky inflation will, prevented the Bank of England from cutting interest rates in the December meeting, where policymakers left rates on hold at 4.75%. And the Bank of England is going to want to see inflation cooling back towards trajectory in order to cut rates again in the February meeting. Now, the data comes after a pretty volatile week for the pound and the UK bond market last week, as investors fretted over the inflationary and fiscal outlook. Now, we saw that big sell-off in bonds. We saw a weakness in the pound, and that's basically pointing to capital fright as the market loses confidence in the UK and the government's ability to manage public finances. Now, this is interesting because we've got the pound here. It's fallen down from that 134 in a falling channel. We've fallen below this trend line, which dates back to 2007. However, we do seem to be just sort of finding our feet around that 123 level. We saw that longer lower wick suggests that there was less selling pressure at those lower levels, which may mean that we're sort of towards the bottom of that run lower. So, I mean, the 123, that's going to be the level. If we get a close below 123 this week, then I think that will open the door to further weakness towards the 122 level. However, if we do find it holds above the 123 to close, then on the upside, you've got this trend line that we've just talked about, which is around the 124.20 level, and then 125 round number to be watching for. So if we get hotter than expected inflation, then that may help the pound US dollar to get back towards the 125 level. Just sticking with the UK, because we've also got UK retail sales. Let's just pull up the FTSE. Okay, so this is the FTSE here. UK retail sales will be released. Let's just double check. I believe they're on the Friday. They're usually on the Friday, aren't they? So there we go. Got retail sales on the Friday. Basically, UK retail sales, they disappointed in November, rising just 0.2%. Now, the market will be hoping for a stronger December following figures from the British Retail Consortium, which showed that Black Friday spending lifted retail sales at the end of last year. Now, given the timing of Black Friday this year, retail sales could find that they beat a more favorable comparison. However, the outlook for retail sales has been, I think it's turned more gloomy following recent market developments last week. The sharp rise in the cost of borrowing for the government as bonds sold off has basically wiped out Chancellor Rachel Reeves' buffer zone, meaning the UK government may need to either hike taxes or cut spending at the March statement just in a couple of weeks' time. Now, a deteriorating position of households and of the fiscal backdrop mean potentially fewer Bank of England rate cuts. So consumer spending may struggle in the near term. As a result, we've seen retailers fall sharply across the board in the previous session. So this is the FTSE. We can see we've rebounded off that low there of 8,000 just at mid-December, risen above the 50 SMA, the 200 and the 100 SMA, and run into support there at 83.25 as if on cue. It's just coming off lower. I mean, if we get some solid retail sales data, that may encourage the market towards retailers which have suffered at the start of the year. Buyers are going to need to rise above that 83.25 level to test the 8400 and 84.80 for fresh all-time highs. We get weak data. Watch out for the 200 SMA on the downside. That's support potentially around 80, around the 82.30 level, and a break below there brings 81.50 into focus, which is a level which has proved to be important across the recent months in the FTSE. So let's just see what else we have going on. Not actually on there because they're showing up as a medium thingy, but it's just worth keeping in mind that there are the ECB monetary policy minutes will be released next week on Thursday, and they don't tend to be massive market moving reports, but it's very interesting as far as knowledge is concerned, and just so we can keep an eye on what to expect from the ECB over the coming meetings. So that's one to be watching out for. Again, several Fed speakers as well. What we'll see here, this is the euro US dollar. We've seen that but the euro US dollar has weakened again quite sharply. Can we see those longer lower wicks on that chart? Downtrend here, longer lower wicks, upper wicks suggest there is little demand on the upside. We're seeing some weakness again in the euro, basically because the ECB is expected to cut rates on numerous occasions, and the Federal Reserve is, and also the health of the Eurozone economy is much worse compared to the strength that we're seeing in the US economy. And as a result, that means that the euro US dollar could potentially be heading towards parity in 2025. Just some levels to be watching on the downside, 102.72, and then obviously this level here, which was the low from 2025 this year at 102.2240. They're the levels to be watching on the downside. If we get a break below there, then I really would, think about 102 and parity. On the upside, you've got 104, then you've got the 105 level to be watching. And now we also have Chinese data, okay? We've got GDP, industrial production, and also retail sales. It's Q4 GDP. Oh dear, it's not coming up. Hang on. Let's see what's going on here. Okay, so expectations for Q4 GDP to rise 5.1% year on year, up from 4.6% in Q3. Full year GDP is expected to rise 5%, according to the president of China, who has signaled that that he could potentially look to meet, to 5%, which is on track for official targets. Although those figures won't be released until later this month, the annual ones, but we do have the Q4 ones. And basically, I think, there's this expectation that the economy has improved considerably after the policymakers rolled out stimulus steps since late September to support the economy, and that's expected to continue into 2025. However, it's also worth noting that Chinese inflation slowed further in December, raising sort of deflation risks. As far as the other data is concerned, we've also got, as I said, industrial production and retail sales, which are both expected to improve. Now, if we have a look here, this is trading within a falling triangle. We're testing that lower bit at the moment at 19,000. RSI is below 50, so that's supportive of a breakthrough, which then opens the door to the 200 SMA, which is at 18,620. And then below that, the 18,500. There's some levels that I'll be keeping in mind. On the upside, first target is going to be the 100 SMA at around 19,500, and that's going to be topped by 2,200 in order to create a higher high. So we have raced through everything. That's pretty much everything. If you've got any questions, then do please pop them over to me. Otherwise, have a great weekend, and I'll see you next week.